but let's address in the divergence of over 3% between Nifty and the mid-cap index, which is perhaps the biggest that we've seen in almost 3 years. The real question that we'd want to ask, what's next for the markets, especially for the broader index? Time to book profits, or would you want to look at it more closely to try and decode carnage in the witness in the broader index and how to navigate this forward? We're being joined by Feroze Azeez, Deputy CEO, Anand Rathi Private Wealth Management. Morning there.
Morning, Nikki. How are you doing?
All good.
I'm glad to be on your show.
Pleasure. Pleasure is all mine. I'm going to start off by asking you what's your assessment essentially on the broad-based sell-off, not a broad base exactly, a carnage that we saw in the broader index and the divergence that took place between the large cap and the mid-cap names. Do you think market participants now should be more cautious? And if that's the case, which are the pockets that they should be closely looking onto?
I personally think at all points in time, a mid-cap and a small-cap investor should be cautious. That's a common variable, point one. Point two, I think yesterday's sharp divergence of almost about 3-4% between small, mid, and Nifty was largely driven by a rumor. Of course, emanating from Society General, one of the head traders being terminated was the rumor. Of course, there's clarification from the said individual, which should calm the nerves of the participants, point one. Last few days, we have been hearing a lot of fund managers, large institutions being cautious about it, and then top it up with this kind of a rumor. I think there is some degree of investigation needed in this whole carnage, point two. Point three, I think mid-caps and small caps are going to be a game where you're going to be very specific. You have to understand the holding pattern of each mid-cap you own if you're owning as a direct equity. Now, for example, when we research to invest through a mutual fund itself, we try and see what is the kind of FPI holding, what is the kind of domestic holding, out of which how much is index fund holding. So then you will understand what kind of stability in terms of the shareholding pattern exists, because the promoter would own, let's assume 60%, the rest of the 40% is also going to be available in the market. How much of the free float is actually very fragile is the assessment of one needs to do, especially in the small cap category. Point four, I don't think this will cascade to a large number of stocks, because the high quality stocks, small cap and mid cap, the ones which have run up, also didn't show a steep correction yesterday. So net, the point I'm trying to make is be cautious all the time. But being cautious is not sufficient. Go into the nitty-gritty of why a stock behaves the way it does is completely because of the holding pattern and the homogeneity of a group which owns it.
Feroze, first, I want to congratulate you for completing the milestone of almost 11 years in the organization. So congratulations on that one. But given the expertise that you've garnered over a number of years, almost 11 years, from a very investor perspective, how would you allocate your portfolio now, especially after the carnage that we've seen from the broader index? Do you think you'd want to change that allocation a little bit more towards the large caps now?
So thank you so much for your wishes. Of course, 11 years of learning and continue to do so, because learning is a part of life, but it's very important to learn the variables, which is what I've learned, decide what to learn and learn it deep enough. So there are several hypotheses currently also I'm checking. One of the hypotheses is that if there is a broader market divergence, what is the behavior of Nifty subsequently? That will derive the strategy of the portfolio. Let me give you in a nutshell, looking at the contemporary situation, where you should be placed. In my opinion, there's not too much to worry. Nifty will continue its trajectory. Of course, a 4-5% correction at all points in time has to be provisioned by an investor. You should always provision 4-5% out of your portfolio, saying this is provision money. You can always see a depletion in the momentary periods. But we think general elections are a huge opportunity this time around, because there's a kind of influx which is waiting for some degree of clarity on this, and there could be further momentum. We have broken out of ranges. Our valuations are fair. Why are they fair? Because we saw 18% growth in the first quarter. We look at macroeconomic variables, which clearly tell you that the next quarter GDP will also give you a reasonable surprise on the upside. Because if you look at the IIP data, you look at the inflation data, you look at the GDP data, you look at the fiscal prudence, all of this, if you are going to predict it ahead, the macro data, which is the most important, is the GDP data, but then you have several minute constituents which give you a lead indication of what kind of GDPs you might end up this financial year. And I think 6.2 will be surpassed to 6.3, 6.4. So 70-75% in equity, to my mind, is a mandate for long-term monies. If you're underinvested than this, you should invest. Of course, some degree of staggering, especially in the broader market, might make sense because of the 10-12% outperformance of the broader markets vis-a-vis Nifty over the last 5 months. And on one of your channels, sister company channels, I had said on 2nd January 2023 that small cap is the space to be in.
So out of the 75%, correct me here, I'm not sure if I got all of that, what you're saying. 75% of the equity allocation, how would you kind of within the equity allocation, how much would you allocate to small cap, mid caps and large caps, especially after what we saw in the previous session? Do you think it's a precursor to something which could be bigger in nature, or you think it was just one of the sell-offs which perhaps took place given the valuations were a bit of lofty and that could serve as an entry point for these stocks?
I definitely think that these kind of corrections are entry points, and I don't think that the bull run in the broader market is over anytime soon, especially not in this calendar year for sure. So to answer your pointed question, if you have 75 rupees in equity, and if you're a mutual fund investor, first category of investor, you should have 28, 29%, or even 30% in the small cap category, 20% in the mid cap category, and 50% in the large cap category, because the mutual fund has very clearly defined this segments. 150 stocks is mid cap, and the subsequent 250 largely are the small caps, and the top 100 are the large caps. So 50-20 in mid cap and a larger allocation is small cap, which is very contrarian. So I'm just emphasizing smaller proportions to mid cap, which is the 150 stocks between 100 and 250. If you are a direct equity investor, then definitely your large cap allocation should be more. 60-65% should be in large cap, because you being able to research a fewer companies is what is going to be the net outcome of an individual investor, because you have to get into the depth of it. So 65 in large cap if you are a direct equity investor, about 20% in small cap, and the subsequent the rest of the 25%, 15% in mid cap is the sensible thing to do. But if you're a direct equity investor, you cannot have just 50% in large cap. You will have to have 65%, because you will not be able to research 250 stocks in the depth they desire.
All right, so let's get in more sector specific now that we've addressed almost the broader ones. First is, let's talk about the BSE Metal Index. Almost surged 10% in the last 1 month, despite the raw material prices that we've seen that could dent the margins. How are you looking at this space given the kind of cues that we're getting from China? Does that space look interesting to you?
Yes, it does. I don't think in a short term, China's impact would be too much on the businesses. Of course, prices are always an anticipation of future business. But one thing which really gives me some degree of hope is the capital expenditure on the government side has been decided to be done in the first 9 months of this financial year, given a large election event. So I think that will definitely trigger a couple of sectors. And of course, this metal sector will definitely get a benefit of it, point one. The consumption or the consumer staples, which I have been calling out for some time, will also get some benefit because of the cascading rural demand, which will generate. IT and railways has been one of the sectors which I've been speaking about for the last 3 months. I think they have outperformed. I think still there is some degree of steam in terms of outperformance with respect to industry, which is possible on the other two as well. So totally 4 sectors is what I think you can place your bets on.
I wanted to chat about the PSU companies which perhaps suffered a steep slump in the previous session as investors rushed to book profits after a months-long rally. Do you think the fundamentals have changed a little bit and this was perhaps the time that these companies witnessed some correction? Or you think, it was just an irrational, profit booking or the carnage that took place in the previous session which led to this sell-off?
I think some degree of reality check in the PSUs is needed. Of course, they've been rallying substantively. When we look at PSUs as a segment, we are not looking at price too much, but we are looking at dividend yield. Of course, if the prices rise up so much, the yields have come down. The historical average yields are significantly more than the yield at the current price. So I think unless there is a structural reform which is possible in the PSU, which is possible, but that's a long-drawn process, you should buy it when the yields shoot up in specific stocks greater than the 5-year average yields of the dividends which those stocks have come on.
All right. I'd also want to understand, what do you make out of this new IPO, RR Kabul IPO, which is coming? Are you looking at it?
Well, no, to be honest, I will not even be qualified to comment because I've not researched it enough to comment. Sorry.
Sure, no problem. Let's also talk about the oil and gas companies. You think a bit of traction, re-rating perhaps could take place? How is the crude behaving and how would you link it to the sector, the broader trends playing out for the sector and the picks that you like within the space?
I think I would stay away because the beta it'll throw up with Nifty is going to be larger for the kind of risk reward is not favoring. Of course, crude has seen some sharp rise given what the US has done with its refineries. So I personally think that I would stay away from oil marketing companies, especially.
All right, Feroze, we're just going to leave it at that. And thank you for taking out the time and speaking to us this morning.
Anand.